was a flow to it. Make up for the lack of available information, he relied on building his own theories on how the market worked. He sacrificed all his time. After 2 years, working part-time jobs and studying the charts every single day, the moment had come. By living frugally, he had managed to save up $16,000. It was time to face the markets.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets.
BNF was anxiously trading to make a living, but the market he faced was an unforgiving bear market. As you know, in 2000, the global stock market had just been hit by the burst of the internet bubble, aka the dot-com bubble. But what you might not know is Japan had already experienced a huge asset bubble burst in the 90s. It was known to Japanese economists as the lost decade, where assets prices dropped over 70%, a decade of terrible economic pain. Despite studying the charts for 2 years, BNF started suffering initial losses. However, through his experience, he quickly developed a strategy that was simple yet brilliant. In a bear market, the overall sentiment is fear. People hate losing and think positive upswings are unlikely in the short term, so they underestimate their likelihood. His strategy was contrarian trading. BNF found when traders are fearful about the overall bear market, they will often oversell falling stocks to avoid the pain of losing. Or in BNF's own words, when going for a short-term rebound, what you should focus on is the moving average divergence. In the bear market of 01, I would only look at stocks deviating at least 20% off the 25-day moving average, with 35% being somewhat a safe level to buy. Price would then surge, and I would close the trade in a profit. But it wasn't as simple. Even after stumbling upon this revelation, a lot of BNF's trades were losses. With more losers than winners, it was painful to see his hard-earned savings shrink. To him, it seemed like some sectors of the market were trickier than others. Despite the pain, he knew it was unrealistic to expect overnight success. Instead, he decided to focus his mind and double down on analyzing his losers. Studying the losing charts, BNF had realized his losers were repeatedly the same sectors, and each of them had different repeating deviations. He concluded the divergent percentages are different per sector, or in BNF's quote from his old two-channel posts. For service sector stocks, the range of deviation from the 25-day moving average was between 22 and 30%. For the post-dot-com crash IT stocks, the ranges were 25 to 45%. And for emerging stocks, it was 28% to 60%. Applying different numbers per sector allowed him to find greater entries to the temporary upswings. BNF had learned first had to develop a feel for the sector before being able to make a trade. With his intense focus, he was producing more wins than losses. But by December 2001, the bear market got even more insane. There was a massive crash in penny stocks. It was like a market-wide Black Friday sale. BNF saw 20% deviation opportunities everywhere. These were companies with strong brands and often liquid war chests. A lot of BNF's friends, now on two-channel, started buying in. It looked like the perfect buying opportunity. But to BNF's instincts, he felt there was a problem. When everything is on fire sale, is it even a sale? So he passed. Having learned that different sectors have different points of rebound, that was no different. Instead of stocking up on the fire sale, he only focused on the extreme cases. Stocks that dropped significantly greater than the market average. Stocks closer to 65% deviation of the 25-day moving average. He made the right call. All the stocks rebounded after only 1 to 2 days. A lot of them jumped up 50%, and some even doubling after 2 to 3 trading days. Remaining calm and applying his self-developed feel over the market had paid off. If he had bought into typical levels like his friends, his losses would have been catastrophic. Instead, by the end of 2002, BNF had grown his account to $1 million in US dollars. He had become the great bear of Japanese day traders. The high was exhilarating. He was finally living off his trades. But then a tragedy happened to BNF to turn his whole worldview dark. massive bull run. You heard that right. That's the tragedy. While the whole world was ecstatic, BNF was stressed. See, BNF's strategy only worked in a bear market. He needed the fear sentiment. But now the market had flipped. He was facing a whole different opponent. To continue making a living trading, he had to figure out how to beat this new bull market. And what made things worse is he actually had some money now. He didn't want to lose his freedom. To ensure he didn't blow his account, he had to find a system to minimize his risk. From his past trades, BNF learned the importance of market sentiment. To minimize his risk, he decided he didn't want to fight the bullish sentiment. Instead, he wanted a strategy that profited from it. I mean, we all know bull markets. As long as you hold, you will make money in the long run. But you can't day trade that. So instead of holding long term, using his understanding of codependency in the Japanese market, BNF found a way to ride the bull run. When the market's strong, core companies tend to rise with the index. What BNF found is core companies don't go up at exactly the same time. They're always laggers, and that's where he buys. He would ride these laggers up and then sell after a few days or weeks. Since these opportunities didn't appear every day, his trading transformed into a few trades per month. Instead of trying to force his trades, he stuck with his strategy. Through years of experience, BNF had come to few trades.
What if you could earn money while just living your life? With Moomoo, you can earn 5.1% APY on your
Day traders. The high was exhilarating. He was finally living off his trades. But then a tragedy happened to BNF to turn his whole worldview dark. Yep, the whole world went on a massive bull run. You heard that right. That's the tragedy. While the whole world was ecstatic, BNF was stressed. See, BNF's strategy only worked in a bear market. He needed the fear sentiment. But now the market had flipped. He was facing a whole different opponent. To continue making a living trading, he had to figure out how to beat this new bull market. And what made things worse is he actually had some money now. He didn't want to lose his freedom. To ensure he didn't blow his account, he had to find a system to minimize his risk. From his past trades, BNF learned the importance of market sentiment. To minimize his risk, he decided he didn't want to fight the bullish sentiment. Instead, he wanted a strategy that profited from it. I mean, we all know bull markets. As long as you hold, you will make money in the long run. But you can't day trade that. So instead of holding long term, using his understanding of codependency in the Japanese market, BNF found a new, clever way to ride the bull run. When the market's strong, core companies tend to rise with the index. What BNF found is core companies don't go up at exactly the same time. They're always laggers, and that's where he buys. He would ride these laggers up and then sell after a few days or weeks. Since these opportunities didn't appear every day, his trading transformed into a few trades per month. Instead of trying to force his trades, he stuck with his strategy. Through years of experience, BNF had come to view trading not as individual price action, but rather as one global machine. Understanding the relationship between individual parts of this machine and his unemotional discipline, that's his genius. This strategy allowed BNF to maintain profitable returns in the bull run. His account grew by 10 million in 2 years, and that's when things took a weird turn. It's December 2005, 9 a.m., another morning on the Japanese stock exchange. The markets are rowdy as various new tech companies had IPO'd on the market in the last few months. Traders were hungry for that next unicorn company. However, this morning, their eyes were on a new stock, JCOM Holdings, as it went public on the emerging markets. Within minutes, panic emerged. BNF couldn't believe his eyes. JCOM looked to have one of the greatest stock drops in history. Unsure of what was going on, traders were hesitant to buy. Concerns of financial fraud grew, and the internet started going wild over the story. host securities, and now was fearing for his life. He had made an unimaginable mistake. His job was to sell one share of JCOM at 610,000 yen.
It just went off.
But instead, he sold 610,000 shares for 1 yen each. After it went live, there was no reversing it. Luckily, the Japanese exchange has what you call a limit up and a limit down, meaning there's a limit to how much a stock can move up or down in one day to prevent highly volatile situations such as these. But it wasn't enough. BNF moved quick. In a matter of minutes since the incident, he attacked. He bought 7,100 shares at the limit down price, which gave him an unbelievable 49% stake in the company. He put half his entire